We know that JPMorgan launched the JPM coin, and you also just announced a Canton network integration. How do you look at deposit tokens versus stablecoins?
In some ways, they could be competitive to stablecoins. In some ways, we think they could actually be complementary. When we think about this superpower of blockchain technology, it's really this ability to have multiple types of assets and cash sitting side by side.
What's actually stopping a wealth advisor today from offering tokenized PE or hedge fund access through a private bank? Is it technology?
The technology, I don't think is the bottleneck. I think we need to scale it up, expand it out to other types of alts as well.
If we're sitting here in 5 years and tokenization has fully matured, what does the wealth management industry look like that doesn't exist today?
Yeah, I think the biggest thing that doesn't exist today is...
Welcome to another episode of 51 Insights, today with Dennis Cristallo. Dennis, welcome to the show.
Thanks so much for having me, Marc. Big fan of your writing, so excited to have this conversation.
Yeah, likewise. Dennis, I'm very excited to have you here. You are leading wealth management for Kinexys Digital Assets at JPMorgan. You design and blockchain tokenization solutions for the private banks and its clients. You did a lot in what JPMorgan Kinexys, their digital asset solution, and I'm super excited to unpack this today. You also had a lot of recent announcements that are very exciting that we're going to unpack today.
Sounds good. Let's do it.
So Dennis, first question. Many banks talk about digital assets. Few build at the depth like JPMorgan has been in the game since years, and Kinexys now has processed over 1 trillion in total. What gave the firm the confidence to commit capital, talent, and also stake their reputation this early while other players waited on the sidelines?
Yeah, sure. So we've just surpassed 3 trillion in total tokenized notional value. So we're a bit beyond the 1 trillion mark at this point. But to your question, I think the approach and the investment in the space has really been enabled by just being incredibly relentless on trying to avoid complacency. If you look at Jamie's recent CEO and chairman letter, literally one of the first few sentences in there is about the emerging threat from fintechs and tokenization related different initiatives in the space. So we definitely want to understand the different threats and the opportunities for all of the different JPMorgan lines of business. In order to do that, you could buy teams, you could partner with consultants, or you can try to build up those capabilities internally. And we chose the latter. And as you mentioned, we were pretty early to the game. We started predecessor groups to Kinexys back in 2014, where there was a small group in the bank. And the idea was, do we need to defend against this technology? Do we need to try to utilize this within our businesses? And so this group went away and they came back and they said resoundingly, yes, we should be looking into this technology because it's incredibly powerful for moving assets, for moving value, and for moving information. And when we think about this superpower of blockchain technology, it's really this ability to have multiple types of assets and cash sitting side by side. And when we think about our businesses within JPMorgan, really all of them are doing different variations of moving assets, value, and information. So we do think this could be incredibly valuable today, tomorrow, and especially as this industry grows. We think there's a lot of different use cases that we could put these tools to work within. And so, I think over time, the focus for our group has evolved from being kind of this internal consultant for all things blockchain, crypto, digital assets within JPMorgan. And today we're more of a commercial business unit where we have some expertise and we have some skills and services and solutions that we're out there talking with, other asset managers, other financial intermediaries to try to help bring them on chain, whether that chain is public, you've alluded to some of the recent announcements, or if that's more of the private chain solution where we've built historically.
And you also co-authored the Bain paper that sized the tokenization opportunity at $400 trillion US. So, and as you said, you've been building inside of JPMorgan since the Onyx days. That's how it was called before Kinexys. What was the moment when you realized that this is not some kind of internal science project play? Like, this is not just Bitcoin. This is much bigger, and this could potentially be transformational for banking and the financial industry.
Yeah, sure. So I've been on the team for about 3.5 years, and I spent prior to that about 10 years building portfolios of hedge funds, private credit funds, co-investments, things like that. I'm saying that because one, have the expertise and have felt the pain points associated with that specific use case of delivering alts at scale. But the team's been around for much longer. And even before I joined, they were, very much at scale as far as delivering some of the core applications to our client base. And so our flagship one is called digital financing, or it's known as this intraday repo application. And that's been at scale for quite a time. And what we're doing there is we're enabling wholesale intraday lending activity with the borrowing leg of the transaction and the cash leg of it also happening on the same set of infrastructure. And really what that does is it allows us to give hyper precise intraday lending, and we're able to unwind these repos effectively instantly. And the benefit there is that clients, if they borrow for an hour, they only pay an hour's worth of interest, and there's no overnight capital charge because it's an intraday loan. And so this idea has been at scale for a while, and I think the approach historically has been very use case specific, like the one I just mentioned. I think now we're at a place now where we're trying to think much bigger picture, especially as we're now able to deploy assets on public blockchains. What does this overall industry and idea start to look like when you have all those assets or many more assets sitting side by side with each other? For us, every time we do something meaningful, especially with the tokenized alternative investment platform that you mentioned, the outreach internally, externally from folks all around is pretty overwhelming in the sense that people want to understand it. People think it's really cool. And I think it's also just a reflection that the pain points that we're targeting really resonate with people, and they're particularly acute in specific industries.
If we take a step back, can you paint us that journey from where you started in the early days with Onyx and now what you call Kinexys? How did that project look at the very beginning? And as you just described, how did that evolve now into something much more broader and powerful?
Yeah, so the team we did do a rebrand last November to change the name from Onyx to Kinexys. The main idea is that when we came up with the Onyx name, it sounded cool, it sounded mysterious, people didn't really know what was going on, and we were doing these really cutting edge, interesting proof of concepts and works of using blockchain and tokenization. Over time, like I mentioned, this evolution towards being more of a commercial business unit, we wanted to actually put something behind it that means something. And so just recently and probably by the time this comes out, we'll launch a new kind of vision for the group, which is around this physics of finance. And so for us, this Kinexys name is about kinetic energy and meeting clients all around the world with more interesting ways to utilize their assets. So it's the same group, it's the same team. It was a marketing rebrand that we did, but it was really meant to kind of refocus the group on the mission right now, which is to tokenize the world's assets and to do so in a way that we're building commercial relationships.
One of the reasons I love to have you here today, Dennis, is that at least in the crypto industry, banks are often painted as adversaries and they want to beat crypto and things like that. But if you talk to people like you realize how much thought is going into what you guys are actually building inside. It's great to have you here today to talk about this. When you have these internal conversations with your colleague, how do you look at blockchain and crypto as a technology? Is crypto still a thing, or are you mainly focused on blockchain as a technology to kind of improve the plumbing of financial services?
I think we generally, at least the way I think about it, we separate the world into kind of the money crypto and the tech crypto piece, and there's a very big gray area in between. We definitely sit probably more on the right side of that spectrum, where we're looking more at the tech crypto aspect of things, where we're trying to use this technology, bring real world assets on chain and create new kinds of utilities and new ways to distribute these assets and interact with them. And so for us, the focus is primarily on the technology side of this. That said, now that we're doing things on public blockchain, you start to get into more of that money crypto or pure cryptocurrency side, where now we need to be mindful of crypto wallets. We need to be mindful of paying gas to facilitate transactions on behalf of our clients who are asset managers. That gray area that I mentioned definitely comes into play. But the Kinexys group, we're focused on more the traditional assets than the cryptocurrency side for sure.
You said you run Kinexys, processes about $5 billion daily. Kinexys runs on a private blockchain, correct?
That's right. Yeah. So most of our applications are on what we call Kinexys Digital Assets. And that is this private permission network. It's a fork of Ethereum that we stood up back in 2014. Now, and we alluded to this a couple times, well, I'm sure we'll dive in, but we've recently deployed a few different assets onto public blockchain networks as well. And the way we got there, and this is really the realization of a vision that we had a long time ago, is we're building using the same tooling. In a lot of cases, we're building in Solidity, we're using similar type tech stacks. And so the journey from private permissioned Ethereum-based chain to a public permissionless chain wasn't nominal by any sense, but it was definitely eased by the fact that we've built and tested a lot of this stuff that we've done already.
And how do you look at that differentiation between permissionless and permission? Do you think that's going to be a setup where both worlds will co-live, or do you think it's going to eventually end up in a more like permissionless environment and lots of different blockchains, open blockchains connected with each other?
There is space for both permission chains and permissionless chains. And for us, we really think of it as pretty use case dependent. So at this point, we're agnostic. We could help clients, we could help asset issuers bring their assets onto public chain or onto the private chain network. And for us, it becomes really more of a question of what are you trying to do? Like everybody sees and hears the noise around tokenization, it's going to change the world and all these different things. And we agree, but not as many people truly appreciate why, and why are they taking these assets and putting them on chain. So for us, the way we look at it is there are very distribution-focused use cases where we're taking an asset and we're putting it on a public blockchain, primarily today as a means of distributing that asset to this new and very fast-growing user base, right? So the crypto natives, the stablecoin holders, the stablecoin issuers, these pools of capital that live on chain, and that is a fine use case, and that's working well. On the other end of the spectrum, we have clients that want to say, bring their assets on chain because it's incredibly painful to deal with these assets. It's very inefficient. Like in the case of alternative investments, it's very labor intensive. It's very manual. Cash and assets are completely divorced as it relates to capital calls and distributions. And so for those use cases, I think it makes more sense to use the private permission network because we don't have to require our clients to have crypto wallets. We don't have to do additional sanction screening and transaction monitoring because all of that happens today behind the same infrastructure that JPMorgan Payments uses. And so it's an easier way to have that streamlined use case as opposed to you try to do that same thing on crypto rails, on public blockchains. Now every user of it needs to get very smart on wallets very quickly, and they're not necessarily there yet.
Dennis, you just launched Kinexys Fundflow together with Citco. Can you unpack a little bit for us? What's that all about and how does this work?
Sure. So Kinexys Fundflow is an application that we built. And the idea is getting at that inefficiency in delivering alternative investment use case. And so today, for anybody that's been around the alts industry, especially dealing with high net worth individuals, you'll know it's quite painful. And it's really painful because there's no DTCC in the middle. There's no standards around how data is shared, how capital calls are processed. And so what you end up with is the three major participants in delivering alternatives. You have your fund manager, who builds the product and manages the money. You have your fund administrator / transfer agent, usually the same in alts, where they're the ones holding the pen on who actually owns this investment and processing capital calls and things like that on behalf of the fund manager. And then the third party is the distributor, which can be a wealth manager, RIA, or a private bank. And so where you landed in this space is that all three parties have different systems. They have different definitions, different data schema, and they don't talk to each other very well. And so the first thing that we wanted to do was to enable better data management amongst these parties. And the way we did that is instead of going to them and saying, hey, here's a new template to use, just fill this out and everything works. That would be the easy thing for us, but we actually didn't do it that way. What we did is we said, how do you consume data? How do you output data? And we built a discrepancy surfacing tool that allows them to see where there are issues in that data. And honestly, you don't need a blockchain for that. It's helpful, but you don't need a blockchain for that. You just need better data management. The more interesting thing, though, and why we did that, is because when we start talking about capital calls, that's where things get really challenging. And so for a capital call on a private equity or a private credit fund, the fund manager may say, I need $10 million from these 1,000 investors, right? And so that 1,000 investors, that gets bundled up by the fund administrator. They send over a file, individual statements to the fund distributor or the wealth manager. And the wealth manager does their best. They pull together the $10 million, get on the phone. How do you want to fund this? All that stuff. And what happens is the 10 million that shows up is really like 9.5 million. And nobody really has a great sense of why that's the case. And so there's a lot of reconciliation that happens after the fact, and nobody knows like who actually owns this thing. And so what we did is, like I mentioned, we used that data management piece, And now when the capital call comes through, we consume that and we kick off a message that starts a transaction flow that begins in the end investor's brokerage account. So in that investor's brokerage account, the money moves to this platform, becomes tokenized effectively, and that tokenized cash gets settled against a fund token with basically what we call a near instant settlement. And so what happens there is the tokenized cash is in the investor's blockchain cash account. That moves to the fund manager's blockchain cash account, and at the same time, the fund token moves from the manager to the investor. And what that allows us to do is really two things. One is it automates the movement of money, so no need for manual wires. And two is it gives us what I'll call almost perfect transparency on who actually is paid for this and who hasn't paid for this. And the way we wrap this all together is, there's a nice application or user interface that everyone can see and log in, and it makes their lives easier. That's effectively Fundflow. The other things to mention there really quickly are that, because this data management becomes a lot easier for the fund manager, we've been able to successfully argue that the fund manager doesn't require a feeder fund in this case, which, some cases they're requiring feeder funds just for convenience reasons, and they don't want to deal with the data management. And that saves end investors, 15, 20 basis points in structured costs. And then the last thing I'll mention is that, this for us, it's early days. This was a pilot. We are looking to continue to scale this out. But where we see this going is a future, going back to the beginning of this conversation, where assets interact with each other, where you could do something like, say, taking a money market fund that's tokenized and using that as a funding source for a private equity capital call. And the benefit there is an operational benefit because you connected these two things intrinsically by having them in the same chain. But then it's also a monetary benefit for the client who, effectively eliminates the cash drag that's endemic in their portfolio from funding these particular things.
So essentially you're saying this is predominantly an efficiency play. Like you basically just need better database structure, in that case, blockchain, that handles these range of processes more efficiently. The second thing is, okay, you can now plug in a tokenized money market fund. Then you would have to move to a public blockchain, correct?
Well, not necessarily. I mean, we could also deploy the money market fund onto the private blockchain, which would more seamlessly connect those two things. But you're correct. This, as described, is primarily an efficiency play, which is compelling and interesting, but we do think it leads to better product development. But the other cool thing about it is, we're actually tokenizing these funds, right? Like we're tokenizing this private equity fund. We solved for capital calls. And should the fund manager want to also deploy that fund token for a distribution use case, so selling it on public blockchains, we will be able to do that fairly easily.
Dennis, in December 2025, you also launched JPMorgan's MONY, that's publicly tokenized fund on Ethereum, seeded with 100 million in capital. Can you just explain us a little bit, how did that get started? Why did you launch that? How did this all work?
Yeah, sure. So pretty quickly on in 2025, we realized that we would have a clear lane to deploy on public blockchain. And so we started, taking all the great work that we've done over the years and started building towards the first couple of different public blockchain launches that we would endeavor to do. And where we started is really kind of harnessing the power of the firm. So we started with JPMorgan Asset Management, who obviously has the expertise and the know-how of structuring, building, distributing, and managing money market funds. And so we worked with them to try to get to market quickly. And what we did is in December, we deployed a tokenized money market fund onto Ethereum. It launched with about 100 million of seed capital, and the team that runs that product now is out there having a ton of conversations and raising capital for that particular fund. And so what's cool about it for us is that on the Kinexys Digital Assets team, truly was the realization of a vision that we've had for a long time. The team, is filled with blockchain nerds and people that are super into this space. And, it had been something that we wanted to strive for a long time. And so again, realizing that vision was really important for the team that's in place today and the team that, that we've had historically as well. And so getting there was an important moment for us on that front. And I think from here, it's about how do we take that product, which is cool, and it's targeting, those pools of capital on blockchain rails, on public blockchains. How do we take that product and make it better than the BAU version, the regular way money market fund? And for us, we have a very clear path and vision towards how we get there, and it involves really three main things. One is trying to get to 24/7 liquidity, where an investor has options to get out of this fund any time of day. Two is what I would call hyper precise or minutely interest accruals, which for individuals may not move the needle that much, but for corporate treasurers that have big cash balances and are trying to optimize that, that could be a very significant addition for them, where when they hold the fund for half a day, they get half a day's worth of interest. And then lastly is this collateral use case. And you're seeing more talk about this in the US. Different regulators are very focused on enabling tokenized collateral, and it makes a lot of sense. You can move our MONY fund today 24/7, 365, and that makes it very suitable to be able to pledge it very precisely. And you get rid of some of these issues around double pledging of assets and things like that in certain types of transactions. So all in, we're quite excited about MONY and the future of money market funds. And we'll have at least a few more this year that we'll go live with. And we're also looking to expand to other chains as well.
Yeah, to other chains that runs on Ethereum. So excited about that as well. So another big topic is deposit tokens versus stablecoins. And we know that JPMorgan launched the JPM coin on Base back in November. And you also just announced a Canton network integration. And when you look at that, is right now, Genius Act explicitly exempts deposit tokens from stablecoin regulation. How do you look at deposit tokens versus stablecoins? What's the strategic play here for JPMorgan?
Yeah, so for us, the idea is to extend out this capability that we have, right? So we've had this thing called blockchain deposit accounts for quite some time. It is basically a bank account on blockchain, which is on the private permission network. And what we did here is we took this concept and extended it by putting these tokens onto Base, and in the future will be other networks as well, as you mentioned. But the idea overall is that actually, in some ways they could be competitive to stablecoins. In some ways, we think they could actually be complementary. And so, for example, regardless where we land on the yield debate for stablecoins, the stablecoin issuers themselves, they're going to hold treasuries, but they probably also need a very liquid cash-like product in their capital stack as well. And this could play that role, right? So this is a very liquid type investment. It will eventually have some yield associated with it. And we're going to be connecting this directly to JPMorgan bank accounts. And so you'll have the ability to more easily on-ramp and off-ramp from JPMorgan bank accounts to this deposit token product. I'll mention still relatively early there, but as far as stablecoins versus deposit tokens, I think more complementary than people recognize, and we'll see how the market develops. I think ultimately, wholesale money will likely move through deposit tokens more likely than stablecoins.
And we often have this debate with guests on our podcasts. How will that stablecoin situation play out? Will we have like an explosion of different stablecoins and every bank will have their own stablecoin? Or will we have like a consolidation around certain issuers like Circle and Tether, and we'll mostly move to deposit tokens on the banking side? How do you think this is going to play out? Do you have a theory here?
I don't have a particularly interesting or insightful theory here. I think, ultimately stablecoins and deposit tokens are a distribution game. And so, the groups today that have done really well at distribution, whether that's through exchanges or through DeFi or otherwise, will probably continue to dominate those types of networks. You'll start to see, and you're already starting to see additional use cases, non-crypto trading related use cases start to proliferate. And I think the groups that solve those problems the best will, get the best distribution, and you'll probably start to see similar monopoly or duopoly-like outcomes like you've seen already in the stablecoin space. Liquidity is incredibly important, and so I think there will be somewhat category killers depending on the use case.
Dennis, your Bain research found that individuals hold around $150 trillion in global wealth, but only allocate about 5% to alternatives. Now you've built the infrastructure to change that. What's actually stopping a wealth advisor today from offering tokenized PE or hedge fund access through a private bank? Is it technology, regulation, or culture?
Yeah, I think...
or all of them?
Yeah, it's probably a combination. I think it's actually less on the regulation side. I think, the way we did it was pretty straightforward as far as, what's actually being tokenized, how it's all working. And so I don't believe anything very controversial there. I think, with a lot of these ideas and the hypothesis that we had going into this is that alts are hard to distribute, right? And so the groups that are good at selling these assets, we want to give them reasons to want to buy tokenized funds on behalf of their clients or enable their clients to buy tokenized funds. And as we get those reasons, which we think will be around, more efficient settlement and being able to connect these to other types of assets, like I mentioned, the money market fund example, and then just streamlining those distributors' operations, we think that they will start to demand these kinds of products. And the conversations that we've had with different fund managers, there's a spectrum. Some fund managers, they basically delegate a lot of their work on the admin and transfer agency side entirely to their TAs and their fund admins, and they're pretty hands off. And so for them, they don't really, care too much about like how this gets done. For other groups, like JPMorgan Asset Management, for example, they are incredibly rigorous and diligent as far as, doing the same set of shadow accounting that fund administrator and fund and transfer agent does. And so what that means is that this is actually a benefit for them too. Making it easier to reconcile, making it easy to know who actually owns this investment benefits them as well as the distributor. And so we haven't had challenges convincing fund managers that this is a good idea. And then on the fund administrator side, we're plugged into Citco, as you mentioned. We do a lot with JPMorgan Security Services, and we have several relationships with several other TAs in the space as well. And it's not that fragmented, so we think we could get there. What I'm getting at here is you need to build the network. It is a network technology. It's early days, but we need to start showing and demonstrating these benefits more completely. And I think we're getting there. We just did our first set of capital calls for the first private equity fund we tokenized. And what we found are two really interesting things. One is that money moved from client account to the fund manager 38 times faster. It was a couple minutes versus like several hours to get the dollars over there, which is great. And then on the other side, the actual labor that went into processing the files and uploading and mapping and reconciling, we were able to reduce that by about 93%. And so for the distributor, it becomes a pretty powerful value prop where you have a very large team that all they do is reconciliations and things like that. And so we think we're getting there. It's going to take a little bit of time. The technology, I don't think is the bottleneck. I think we need to scale it up, expand it out to other types of alts as well. The reg piece, I don't think is the challenge here.
A question about your multi-chain strategy. You're operating across Kinexys private chains, Ethereum, Base, and now also Canton, and each with different trade-offs and also privacy compliance and composability structures. Is the future a network of networks where assets flow across chains, or does institutional finance eventually consolidate around one or two or three platforms? What's your thesis here?
Yeah, I mean, like I mentioned a bit ago, I think there are too many chains, right? And so you will start to see consolidation. We, like others, share the view that interoperability is key to a lot of use case and proliferation of this overall idea. But ultimately today, the way we look at, especially on the public chain side, is we look at them as distribution mechanisms. You have on Ethereum 60% of all stablecoins issued. You have a ton of users. You have very deep liquidity pools. You have all these decentralized apps that people can access. And so for us, when we're working with fund managers, like we want to ultimately deploy tokens and assets where people are there to buy them. And so for Ethereum, that's kind of been the default starting place given the Lindy effect. It's been around for a while. It's quite decentralized and resilient. But then we'll also see other chains where there's more, fintech and B2B2C kind of use cases developing because maybe there's better throughputs, et cetera. And so we're looking there as well. So we need to be everywhere. We recognize that. And how we pull it all together and whether we need to pull it all together, we're still in kind of wait and see mode. I know there's a lot of discussion around, with real world assets. I haven't seen and haven't heard a phenomenal use case around the need to go cross-chain. I think being able to take your assets from chain A to chain B can be accomplished in a number of different ways. Whether that needs to be done atomically or very quickly, I think is a bit TBD. So we're kind of waiting and seeing how that develops a bit more.
And if we're sitting here in 5 years and tokenization has fully matured, what does the wealth management industry look like that doesn't exist today?
Yeah, I think the biggest thing that doesn't exist today is wallets. So for this idea to gain traction, and this idea being a future where wealth is managed almost entirely on chain, like I'm a big believer that that's the direction that we're heading. For that to happen, you need a place and a way for investors to scalably hold these assets, that is going to require some kind of wallet solution. I don't know that, investors are going to want to self-custody assets. I personally have never been like, oh, I want to self-custody my JPMorgan stock, but maybe somebody wants to do that. But I think the point is that you need integrated wallet solutions into broader places where people hold their wealth, whether that's a brokerage platform, custody account, whatever. And then I think once you get there, and once you get a very significant breadth of assets, different types of assets, different asset classes on chain, then I think that's where the magic happens. That's where you can start to really do interesting things as far as deliver managed portfolios at scale with infinite levels of personalization and potentially enabling instant settlement, which the benefit again there is that when you have that, now all of a sudden your portfolio doesn't need to hold like any cash on a meaningful basis, which is kind of a secret tax on a wealth managed portfolio where, there's some level of cash for investments that haven't settled yet or opportunistic kind of trades. And so I think when we look back in the future, maybe 5 years from now, this idea of idle cash is going away.
Dennis, you've been building at JPMorgan now for the last 3 years. If you look back at your journey, what were some of the top learnings or realizations you had while building this?
Yeah, so I joined the Kinexys team as a pure hobbyist. I was doing a good amount of crypto related work, digital asset related work on my prior team. But from the technology perspective, I came in as purely a hobbyist. And so, when you come in that way, there's a lot to learn. There's a ton to learn as far as like how it all comes together, what's achievable, what's not achievable. And so I think just overall getting immersed in the technology side of this industry has been tremendously powerful and enlightening as far as, the cool things that can happen and some things that can happen. I can't tell you like how many conversations we go into where we think that we have a beat on like a really good, interesting use case, and we get in there, we're like, actually, that's not really like a blockchain solve or a tokenization solve. That's really just something where you need better data or better data management or cleaner information, that kind of stuff. So I think it's been very helpful as far as truly understanding like which use cases make sense, which ones don't necessarily make sense. And we've had a tremendous team from the time I got here, and it's been just awesome to learn so much from folks within the group, around the bank, and in the broader industry.
Are there any use cases that you think are massively overhyped?
Massively overhyped? No, I think there's definitely use cases that still need to prove it. Like when you look at tokenized assets on public chains beyond money market funds, I still think it's a question of product market fit. I think you're starting to see some interesting things on the tokenized equity side where it's a global access play and that makes sense. But, for other types of assets like alts that have been private equity, private credit funds that have been tokenized on public blockchains, I don't think we're quite there yet. I think some of the earlier iterations had structural flaws associated with them, and you just haven't seen a meaningful bid for some of those assets yet.
And are there any other areas outside of tokenization and banking that you look at that you are excited about when you see what's happening in that industry?
Yeah, look, like what's going on in AI is absolutely mind-blowing. It's become like a part of our everyday lives very, very quickly. And, in some ways that shift and that kind of ChatGPT moment was really interesting to watch from within, another, I'll say like niche technology focused team within the bank, because a lot of attention gets pulled away from what we were doing, which in some ways, is not the best thing, but in some ways actually allowed us to really focus on the mission and focus on like what actually matters. But no doubt we watch and we collaborate very closely with our friends that are working on different AI projects throughout the bank, and there's really interesting things happening there. And, I think there's going to be eventually interesting convergences between AI and crypto, besides, the obvious of using some of the LLMs to help you build different pieces of code. But, maybe going back to your last question, I think a lot of the early discussion on, crypto x AI was probably overhyped. Some of those use cases didn't make a ton of sense. I think it's becoming more refined as we go along. That probably would have been a better answer.
Yeah, definitely agree with you on that. Dennis, we're almost at the end of the show. We usually do a quick lightning round. Those are short questions with short answers. The first one is deposit tokens or stablecoins, which dominates institutional payments in 2030?
For institutional payments, deposit tokens. think it's a more scalable model that makes more sense.
The biggest internal obstacle to tokenization at a global systemically important bank, compliance, technology, or politics?
I think it's just the sheer number of people that we have to bring these ideas to.
A tokenized PE access for the mass affluent, 2027 or 2032?
2027, for sure.
That's great, Dennis. Thank you for coming on the show. It was a pleasure to have you on. Where can people learn more about you, about what JPMorgan is building?
Yeah, as mentioned, the Kinexys team, we're going through a relaunch of our marketing vision, and you'll see some cool content on LinkedIn, on the website, jpmorgan.com/Kinexys. So feel free to go there and feel free to reach out.
Great. Thank you, Dennis, and all the best, and talk soon.
Thanks so much, Marc.
You obviously liked this video enough that you got to the end. Listen, do me a favor, hit that like and subscribe button, because I think you'll like it. And if you want even more, with more I mean incredible alpha, research, and digital asset market updates, subscribe to our newsletter on 51, that's the number 51, insights.xyz, and get the most actionable insights on digital assets. See you next time.